So Russia's wrapping up the pain, and this inflation nightmare isn't over yet. The economic war has taken another sudden turn, and this time, Putin is moving to cut oil production again. We are seeing a classic tit for tat strategy, and over the past 12 months, the West they have been hammering Russia with a ton of financial sanctions and price caps. But now Russia is reversing the tables by leveraging commodities, and their weapon of choice is something that they have a ton of, something every country needs to survive, which is oil. In our lead story today, Russia promises to unveil new OPEC Plus supply cut deal next week. And this is scary because it might not just be Putin cutting supply, but the entire OPEC Plus group could be in on it. And this is coming in at a point where everyone thinks that inflation has been won. Yes, energy prices have been dropping, but that doesn't mean the battle is over yet. Everyone keeps forgetting that Russia has their hand on the energy taps. They are not obligated to sell oil at suppressed prices. And when they decide to reduce the flow of oil, inflation will rise. And during a meeting, Putin asked Novak if OPEC Plus had agreed to reduce the global supply of oil. Novak replied saying, "We have agreed, but we'll announce the main parameters next week." And this is one promise that Russia will probably carry out. And they're actually going to benefit from this production cut because they have shored up their demand. Just look at their crude oil shipments. Since the start of the conflict, Russia has effectively diverted their oil flows all the way to Asia. They have tripled their supply from 1 million barrels a day to well over 3 million. They have made up the shortfall of oil that once went to Europe, and now they have ample room to play their commodity games with the West. And this is very frightening. Together with OPEC Plus, this cut could be brutal and might just force the Federal Reserve and the ECB to keep hiking further until something breaks. And understand why Russia is doing this. By constricting supply, they force the price of oil up. And because the demand from Asia is secured, their flow of revenue won't just fall, it might actually increase in aggregate. The only economies feeling the pain will be the West, and it will be Europe that will feel the bulk of it. And if you were the G7, you should be quaking in your boots because all the data points to this being a credible threat. According to Bloomberg, Russia's oil passes the price cap as their export revenue hits a year high. Moscow is now selling their oil for well above the $60 G7 price cap, helping them bring in $15.3 billion in July. And looking at Russia's oil revenues, it is obvious that the sanctions are losing their bite. Their oil export revenue has hit their highest point in 2023. This means their previous strategy of price cuts might actually be working. And if it works, you can be sure that Putin is going to repeat this. Back in March, the Russians cut their oil production by 500,000 barrels a day, 500,000, and this represented 5% of their total output. Evidently, this might be working. The proof is in the pudding. They are making more money than ever in 2023. Now, we don't know for sure how big these combined oil cuts will be because it won't just be Russia but OPEC Plus as a whole. For all we know, it could be millions of barrels in total, which would devastate the global economy. And this is the problem with price caps. It looks awesome on the surface, but unless you have the entire world embargo Russia, it just won't work. You'll hurt yourself and Russia until they eventually adapt. Previously, Russia pledged to cut oil exports by 500,000 barrels a day in August, and that's another 5% of their output gone, which then tapers down to 300,000 barrels in September. So we will likely have a 300k barrel per day cut coming, and this could extend further into October. The inflation fight isn't gonna end because whatever fire is being put out by the rate hikes by the Federal Reserve, Russia is reigniting them with their production cuts. In other words, your electric bill isn't going to come down, it might even go up. But what's telling is this move isn't just to protect Russian revenues or the oil price, because Putin can always pump more oil and sell by volume to earn more. So why is he cutting oil production? According to Rosneft, the state-owned oil company, their CEO is decrying the oil output cuts. He is complaining about the production quota, saying it is preventing the company from unleashing their full potential, which basically means maximizing their earnings. And this move really isn't about defending the oil price, but ramping up the pain in the Western economies. This is Russia's move on the economic front. Let's jack up the price of energy to unleash a second wave of inflation. If this inflation nightmare lasts for years, there's a chance that the West might break. But Russia's not alone in this production cut. We are now effectively in a multipolar world where each bloc has enough power to counter each other's move. It's no longer a unipolar system where the G7 can easily control the world economy. Those days are long gone. Russia isn't alone in their oil cuts. Saudi Arabia is joining the fray. And in a Bloomberg survey of oil traders, Saudi Arabia is expected to prolong their production cuts. They believe that MBS will extend the 1 million barrel cut all the way until October, and that's just maintaining the current cut. The Saudis could always increase the cut if they want to push prices higher, right? And listen to this, without continuation of the full cut in October, the Saudis will be risking a $70 handle on Brent, which they don't want to see. Just like the Russians, the Saudis have the wiggle room to keep oil prices high. And let's remember the BRICS expansion. There's a reason why MBS was pushing for membership. There is a critical reason why the Saudis wanted to join, and it's all about securing customers for their oil exports. They know they could be subject to price caps or sanctions from the West. So it kind of makes sense for them to join the BRICS. If we look at it from a business standpoint, Saudi Arabia has secured half of the world as their customers. The BRICS Plus group currently accounts for 46% of the global population. A big chunk comes from emerging economies like China, India, Brazil, and Egypt. Oil consumption there will only keep growing. There will be more customers for energy supplies, and this allows Saudi Arabia to coordinate with Russia to squeeze the West by jacking oil prices higher. With BRICS Plus, they have the demand power, and with OPEC Plus, they have the supply power. And since the start of 2023, both Russia and Saudi Arabia's oil cuts have been getting more and more aggressive. In fact, Saudi Arabia's production has fallen to 9 million barrels a day. That's even less than Russia because MBS knows he can keep cutting production. That's how strategic the whole situation really is. Their dependence on the West for revenue has decreased significantly. So even if we enter a global recession, we should expect the price of oil to stay high. And you might be thinking, won't this oil cut hurt the rest of BRICS like India or China? Well, not really. Beijing has been stockpiling a ton of cheap Russian oil, taking their inventories to the highest level in 3 years. They have been increasing their oil reserves aggressively since January in case of such an event. It's almost as if they know Russia and Saudi Arabia are going to cut production. And if we compare China's available crude oil versus their refinery consumption, we can see a big increase in stockpiles versus what they are using. There's a lot of excess oil being bought versus what they need. There's 10 million more tons than what they are consuming, and this is flowing into their reserves. BRICS Plus is protecting their own economies. In spite of all these supply curbs, Saudi Arabia is ensuring Asian customers will get their full volumes in September. And in China's case, they are getting even more. Chinese firms are going to buy 40% more Saudi crude in September versus August. And these volumes are going up even though global supply is going down. Saudi Arabia, they have refineries in China, so they definitely won't cut supply to themselves. And who do you think the shortfall will affect? It will be the Western economies that will take the hit. America is more or less self-sufficient, so they can withstand the oil cuts for now, but the real victim will be the Eurozone, which is already in a recession. And if we look at the price of oil, we can see this tremendous spike up from $72 all the way to $89 since the big production cuts came online. The price of oil is now at a 10-month high. It's the highest it's ever been in 2023. And let that sink in for a moment. Very soon, the CPI numbers will reflect this reality, this sudden spike up in energy prices. So the big drop in US and EU inflation isn't going to last for long. We could see a rebound coming in the August numbers. The CPI numbers will be released on the 13th of September, while the Federal Reserve, they meet on the 20th. And if CPI rebounds higher because of oil prices, another rate hike is coming, and I expect Powell to hike by another 25 basis points, and that will push the US economy closer towards the cliff. And this is the big irony of all the price caps and oil sanctions. The West has essentially boxed themselves into a situation where they are vulnerable to production cuts. All the oil flowing to Asia has been allocated, while they are scrambling for the crumbs. And what Russia is doing is targeting the weak link in their armor. They are targeting the weak spot of underinvestment of oil in America and Europe, which is getting worse and worse. According to the EIA, US shale oil and gas outputs are starting to fall. Shale production is about to fall to the lowest level since May. This is a direct result of underinvestment in the oil and gas industry. Shale oil has a high cost of production and pumping it out is very expensive. And here's the kicker: shale oil represents 66% of US oil production. If supplies from shale gets tight, America would divert their exports to Europe back home. If we can see this starting to take shape, US crude oil stocks are set to fall even further, which makes America more vulnerable to OPEC Plus production cuts. We have record demand, supply cuts, weaker futures, and rising storage costs triggering drawdowns of US oil inventories. And this is what happens when you go green without understanding the energy markets. You put a big target on your back when we are obviously still in a world run by fossil fuels. And in a nutshell, America is consuming more oil than they are producing. And if this gets severe enough, they might resort to importing oil from the open markets. And if that happens, or maybe when that happens, oil prices will rise even further. This is why the Federal Reserve is trapped and probably has to raise rates further to counter this move. Remember the Strategic Petroleum Reserves, the SPR, the one that Biden was supposed to replenish at $70? Well, the price is now near $90. And looking at the SPR levels, the stocks are at a 40-year low of only 350 million barrels of crude. Releasing the SPR didn't work. We have said before how it was like peeing into the ocean. It simply has no long-term effect on the price of oil. Whatever oil America releases to flood the market, the Russians or the Saudis or both of them can cut production to counter it within a matter of days. And now there aren't much reserves left to even release. But the biggest loser of this will be the Eurozone. The inflation numbers are out and they are still stuck at 5.3% for August. Yes, only decreased by 0.2% from July, which is a nothing burger. Remember that Europe is in recession, and if OPEC cuts more production, this recession is going to get deeper, it's going to get darker. And let's look at the inflation numbers of the Eurozone and their two biggest economies, Germany and France. We'll also overlay their GDP numbers so you can see how precarious this situation really is. Inflation in the Eurozone is still disgustingly high, with Germany leading the bloc with a 6.1% CPI in August. The French CPI has also rebounded up from 4.3% to 4.8% because of higher energy prices. In other words, inflation in France is now higher than before. The GDP numbers also reveal how fragile their economies are, and the higher the inflation rate, the higher the odds of a recession. The EU and Germany are officially still in the recession, and their GDP numbers aren't encouraging. 0% and 0.3% are nothing to shout about. France is also on the knife's edge with just 0.5% GDP growth. So just imagine if the dynamic duo, Russia and Saudi Arabia, cuts production even further. This will send inflation soaring, and that could force the ECB to hike further and plunge the EU into deeper recession. Now, Russia probably realized that inflation is stickier than we realize and has decided to dial up the pain by cutting production. And the ECB is on the verge of hiking rates again. We have to watch what OPEC does next week, because if the cuts are brutal, this could confirm another round of rate hikes from both the ECB and the Federal Reserve. So we got to prepare for higher oil prices going forward. All the bears that betted against crude are now getting slaughtered and could get even worse. Analysts are warning that crude oil could average 82.45 in 2023, and this means prices could go higher. But in the latest poll, we could see oil smash past $85 in Q4. We are in a global slowdown, guys, and another wave of inflation is the last thing that we need. And the big fear is what the Fed will do when energy prices go higher or stay high. And yes, we know the Fed pays attention to core inflation, not really CPI. And this is inflation minus food and energy. Right now, core inflation has dropped a fair bit, but it is proving to be stickier than usual. It is only down by 0.1% from June. It is a misconception to think that higher energy prices don't affect core inflation. If the cost of manufacturing goods and services rise, it will get passed down to the consumer sooner or later. And this increase just takes longer time to manifest, but it will. And if OPEC ramps up the pain, we could see core inflation either rise or stay flat, and we know what that means: more rate hikes coming. So we need to watch this carefully because the Fed could miscalibrate and crash the economy. But let me know what you think in the comments below. How brutal will Russia's oil cuts get? And will the rest of OPEC Plus joining and ramp up the pain? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.